Picture this. Two identical twins die on the same day in 2045. Each leaves $1 million in a brokerage account to their only child. Twin A's kid gets about $1 million and a nice thank you note. Twin B's kid gets $3.2 million and a confused phone call from the attorney asking, "How did your father do this?" Same investments, same returns, same everything, except Twin B used 4 perfectly legal tax moves that the IRS literally begs you to take, and 99% of people just ignore. Today I'm handing you those 4 moves on a silver platter. No offshore accounts, no shady trusts, no too good to be true. Just boring, IRS-approved rules that turn middle-class money into generational money. Welcome back to Legacy and Logic. Episode 3 is the one your accountant hopes you never hear. Last week we built the only portfolio you'll ever need. 3 funds, own the world, touch nothing. Today we make the same portfolio spit out 3 to 6 times more money for your grandkids than it would in a normal taxable account. All 100% legal, all available to anyone with a W-2 and a pulse. Here are 4 tax gifts. The magic of zero capital gains. Gift number 1. The single most underused rule in the entire tax code. When you die, your heirs get a full step up in basis. Everything you own resets to market value on the day you pass. Your $50,000 of Apple bought in 2005 worth $2 million. Your kids sell it the next week, they pay 0 in capital gains tax, ever. The widow who inherited $900,000 in stock in 2021. Her late husband had $40,000 of basis. She sold everything 6 months later to buy a condo, paid $6,800 in tax instead of $180,000 in tax. That's $173,000 difference, bought her grandkids college. Never pay capital gains tax. You can die with instead. Here's the next one. Roth everything, forever, is gift number 2. Every dollar you convert or contribute to Roth grows tax-free and comes out tax-free for your heirs for 10 years after you're gone, possibly forever if Congress ever grows a brain. $6,500 a year from age 40 to 65 at 8% is $900,000 tax-free for your children. Do it in a low-income year or during a market crash, and you pay almost no conversion tax. Here's some math. $500,000 taxable brokerage at 8% for 40 years is $3.1 million for heirs after 20 to 30% long-term cap gains. Same $500,000 in a Roth is $10.9 million, every penny tax-free. That gap literally paid off a house or 2. Keep that in mind. Here's the next one. There's a back door to this that never closes, and that's gift number 3. A lot of high earners contribute $7,000 to their traditional IRA, non-deductible. The next day, convert it to Roth. After that, pay maybe $100 on tax of earnings if you're lucky. Repeat that every year. I'm hearing people in their 30s quietly building $2 to $3 million Roth balances this way, while their coworkers brag about 401k balances that will get smashed at withdrawal. It's always important to keep the back door in mind. Okay, last gift. The charitable cheat code, plus qualified charitable distributions. Donor-advised funds, or DAFs, get the deduction today and let the money grow tax-free forever, and you can grant it to charity whenever you would like. Age 70 and a half plus You get QCDs. Send your RMDs straight from IRA to charity. Counts as your required distribution, but never hits your taxable income. Save on taxes, Medicare premiums, and Social Security taxation. Here's an example. A couple in their 70s with a $2 million IRA. They use QCDs, drop 2 tax brackets, save $40,000 a year in tax. That $48,000 stays invested, becomes another $1.2 million for the kids in 20 years. How do you like that? Here's a dirty little secret the tax code never advertises. The government will happily let you keep millions, sometimes tens of millions, if you're just willing to keep thinking in decades instead of calendar years. Your grandchildren won't care what mutual fund you owned. They'll care that you paid the tax once, small, upfront, so they'll never have to pay it again. Next week, episode 4, the one trust almost nobody uses that makes your children rich and keeps them from blowing it. Until then, die with your cost basis as low as possible, your Roth as fat as possible, and your charity on speed dial. See you on the porch.